Hi, this is Randy Finney with Right Side of the Chart, and this is a midday market update for Friday, April 12th, 2019. I'll start out here with a quick view of the broad markets, look at those, and then move on to some of the other things I'm watching. So a little bit of a potpourri mix of some different things out there. I'll look at gold, US dollar, commodities, and it won't be a long video because I'm just going to touch lightly. I've covered the broad markets ad nauseum lately, and there's just not any changes. We have absolutely zero sell signals at this time. The trend is bullish, but we're watching these uptrend lines off the lows here on the 24th of December. More so than SPY, I'm really paying attention to QQQ and XLK, the tech sector, as well as the market-leading FAAMGS stocks. I'm going to get to those in a second. There's our high, our previous high, roughly, and we're about, what, 1.25% away. I'll zoom in here and grab that candle, roughly. Yeah, 1.5%. So whether we pop the highs, reverse just shy, make a perfect tag of the highs, to me, there's just so much evidence in the charts that say the probability is very high that any new high will be met with selling. And again, so to me, I don't know, it's a range, we'll call it just 2-3%. And so it's the same story. The risk reward is just not attractive. So we either reverse shy of the highs, we hit them, or we pop above them. Now, the charts can change. We can certainly take out the divergences by moving higher, bringing the RSI and the PPO up. But here's the thing, and I've talked on this many, many times. Just go back in time and look what happened every single time you get overbought. Just look at these little lines where you're overbought here, especially breakouts to new high that occur when the market's overbought. That's what this one was right here. That was followed by a 20-something% wallop in the markets. Here we had something that this was a blow off top. This was, I mentioned at the time, the most extreme overbought reading possibly in history. I went back 20 or 30 years and didn't see an overbought reading on the S&P 500 back then. I mentioned that at the time, and you can see that's what a blow off top looks like. If you want to put it in the textbook, under the definition of a blow off top, it comes after an extended run that's already overbought, and then just a near vertical run, and then you can see what happened there. So again, it's just simple statistics, putting the odds in your favors, probabilities I should say, more than statistics, or that statistics as well. Just go back in time and look at what happens when the market's already had a tremendous run to get to a breakout to new highs, or is overbought like this. So that's that. Let's not even talk about that anymore. Let's go to QQQ, because that to me is more important at this point in time, because it has a lot of the tech stocks which have really held this market up. So here's QQQ on a daily time frame. You can look at it either way. Doesn't matter. I have these targets here. You can see. We'll see how things look once we finally get a turn in the market. We don't even have that yet. But let's just watch this trend line. We'll zoom in real tight. You can see it off the lows on the 24th. 2, 3, 4. Let's see if that breaks. The divergences are in place. Everything that says we'll get a trend reversal, yes, the divergences have been in place for a while. And we did have a little correction on that first divergent high. We had a little correction on the second divergent high. Now all we need is a little correction on this one to break the trend line, and that could lead the way to a much bigger correction. Either way, there's some potential targets. So that's QQQ. There's your previous other divergent highs, and you can see what happened. And then of course, as I said, the market doesn't break till tech breaks. So tech is by far the largest component of the S&P 500, and several times that of the NASDAQ 100. And so there's our trend line off the lows. There's our divergent high, just like we had these divergent highs back here and here and here, and you can see what followed in those. So maybe it's different this time. Like I said, divergences I have seen burn through, but based on everything, just the spacing of these runs, what's going on fundamentally, just so many variables in the market, tons of outflows this year. Market's still lifting on while we've had a record amount of outflows from mutual funds and ETFs that are in the U.S. stocks. It's just saying that there is a chance for a waterfall type sell-off if this breaks down, and at least, if not a waterfall sell-off, a decent correction, because we haven't had a really decent correction. This was let's just say a half-ass correction back here, a pullback of about 4% or so. So we'll see what happens, but those are the levels to watch, and until then, more of the same. That's all I can say. Let's look at the futures for a second, because I've been updating this chart recently. This is NQE minis, and I talk about all the time. I say, the charts are dynamic, and so is my analysis. So what I have to do here, I've been watching this trend line. We had a breakdown yesterday, not very impulsive, and now we need to move the lines. As you can see, I have this line. I still have a lot of reactions there. I'm going to drag that line because now I have more reactions right here. We haven't really had an impulsive, solid move down through there. You want to see a candle that looks something like this, and big red candle there, or maybe a few consecutive candles. The levels remain the same, 75, 85-ish. You have a minor support level right there, and then that 79.50-ish level. So there's the current uptrend line, and now this gets interesting because, okay, this is a 60-minute chart. Right now we're in one of the strongest moves in history of the financial markets, one of the strongest rallies at least in many years, if not decades. And so it's going to take a little more than a 60-minute chart breakdown. This may give us an early clue, but you're really going to need, going back to those daily charts I was just looking at, you're going to need to see some pretty darn bearish candles, candlestick reversal patterns, trendline breaks, or other evidence there to give you a high probability sell signal. This may get you a jump on it. This may get you some quick pullback trades in the futures. And believe me, it's going to start here. Anything that ends up being a powerful impulsive sell signal on the daily will certainly start out here. I mean, it's the same index. You're going to see it here. So again, you might want to watch this if you're a more active trader. And right now, this is the trend line, the way I'd have it drawn. Same story. We're inching higher. The divergences continue to build, just like they did back here. They built and built and built. And we had divergences along the way with little pullbacks, just like we have now. Finally, we had a big the divergence at one point. It just finally started playing out, and then we also went on after the impulsive move off that divergent high. We broke the trend line support, this widening wedge right here, broadening wedge, back tested it, and that was it. So we'll need something similar here. At least I'm on the lookout for that. ES. Let's look at the S&P 500 E-minis. I had a minor trend line here I pointed out yesterday. That broke, and then we back tested it, but we're back above, and you can see. So, I don't want to try to force trend lines here. Nothing jumps out very strong, but that would be comparable to the one I just gave you on NQ. So let's go off this one right now, again, for an early sign of a potential sell signal. And again, it's how we go down. If we limp down through there again and go on a back test like we did the last couple days through the previous trend line, it's not a really solid sell signal. If you come on down through there strong, that would be a more powerful sell signal. Now I want to loop back real quick to the daily charts here, and again, it's all about tech and the FAANGS stocks. Now let's look at the FAANGS. Something interesting today I noticed. Apple came down pretty impulsively. Let me go through the top components here. Apple came down and tagged that trend line today. Remember, I did a video recently covering the top components of QQQ, telling you that I'm noticing a lot of similar uptrend lines. And again, it makes sense. They're all top components. They're going to move in line with the index, give or take. But Apple made a pretty impulsive run at that. Now, it was support. Like I always say, support is support until unless broken. So you could now, I mean, we're just coming off it, but that's certainly an objective buy point. I have not modified this trend line since the last video, and you can see there, boom, we sliced through it intraday, just like back there. But it's a daily trend line, so you don't have any type of sell signal, or at least a solid sell signal, until you close below there or really move impulsively intraday, not just a brief spike. And we also came down that 197.70-ish resistance or support level, former resistance. So there's Apple continuing to diverge. Watch this trend line. I had a price alert on it today. That's why I wanted to do the video. But I said in that previous video, it's not gonna. You don't just need to see one of these FAANG stocks break. You need to see quite a few. The more, the better. So that was only one that broke down today, and that's as such. That's why we did not have a sell signal in the market. That's why I didn't, mention it on the front page or anything like that. There's the Microsoft still wedging higher, still above trend. Again, there's a primary trend line off the December lows. Same story. So I'm going to spend a lot of time. This was already covered in a recent video. Amazon. But here's the point. They're all at very close proximity. You can look at it one of two ways. We hit those levels. We hit it on Apple today. You can step in and buy if you're bullish. Same with Amazon. It's on that trend line now. You got a little time before they report earnings. Or you can wait for a breakdown of, again, the more you see, the better. There's not a set number, but yeah, like I said, there'll be a day, I suspect, coming soon probably, where you just see big red candles. You're not there. It'll be unmistakable, and it will engulf. That's the dangerous part of these low volume type grinds. You have the potential right now, just the way I drew that candle, and that is not an abnormal candle. Go back here in time, look at all these other candles on Amazon. So they were common. That candle was smaller than quite a few back there in the end of the fourth quarter. And what does that mean? Well, that would wipe out weeks of gains. That's what a bearish engulfing candle, that's the nature of it. It engulfs the previous candles, so it wipes out all those that caved into the FOMO. FOMO is fear of missing out. That's a buzzword right now in this rally, fear of missing out. Statistics show that the vast majority of not just individual investors, but also mutual funds, hedge funds, have missed out on this. This rally was induced largely by stock buybacks and other things like that. So you have the FOMO trade going on now. And again, it's like a game of musical chairs, like those shipping stocks I highlighted recently. They're still booming today. And as long as the music is playing, that's where you want to be, but you don't want to be left standing without a chair when the music stops. Maybe we have a slow roll. Maybe we have the next leg down starts with a bang, and that's why I'm doing this video. It might become monotonous. Same thing every day. Watch these trend lines, set alerts, but hopefully if there is a quick reversal, it'll give longs an opportunity to get out if you're watching this and you're on top of this, and shorts an opportunity to get in. Otherwise, like I said, if you're looking for new highs in the market, just continue to buy pullbacks to this level. It's not my trading style. I don't do it because of comfort level. We're in earnings season, so that even further increases the chance that you will be trapped in a position. Let's just take Amazon for example. Of course you'll have to see when their earnings are, but it could be another company, it could be something else, and you can wake up to a gap down here. Let me draw that a little bit different. You can wake up to a gap down that's, you know what, let me do this. Let me go back here to Apple. Now this was back here, and this is probably why I'm seeing weakness in Apple. You guys remember Apple had a meltdown here. It had a divergent high, again pointed out at the time, divergent high, same watch, rinse, repeat stuff. And again, these were divergent highs that played out for just corrections in an uptrend, and then the divergences continue to build. Remember, there was weekly divergence, so the bigger, more powerful divergences we're not looking at here finally played out for this. Very few people saw that coming. And then what happened here is, along the way, after Apple was already extremely oversold, look at the RSI buried down here, we still had a gap, if you guys recall, and I believe that was an earnings, it was an earnings-induced gap. No, it was guidance. I think they came in and lowered guidance right before they reported, but it was an 8% drop right there, and that was towards the bottom right there in Apple. So I think there's that fear right now, and you'll see it come closer to earnings, that people might be afraid of being caught on the wrong side of a gap, as they should be, especially after an extended run. After an extended drop, that gap proved to be a buying opportunity. You're only going to get so oversold, and again, there were a lot of divergences and things flashing on the broad market saying that the correction was overdone and we'd get a reversal. So I just wanted to point that out, that this being just before that drop down, it was the world's largest company, and you still had in a single day a 8% gap, and that my point being, the best companies, the most solid liquid mega cap companies, are not immune to gaps that can blow right past any reasonable stop. So don't become complacent with a market that seems like it will never go down again. Maybe we go up, but there'll be a point. And again, I'm watching these trend lines. That's what I wanted to do this video on. So a few more, and then we'll wrap that up with the broad markets. Okay, I covered Amazon, which was on trend. Alphabet, I have different trend lines. Here we'll look at the different share classes. You can see I have the white trend line, the BOD, the second of the two, benefit of the doubt, and then the yellow trend line. Very close there on Alphabet. Facebook, I just checked the other day. I checked the short interest on all the FAAMGS, and I think Facebook, if I remember correctly, has had the lowest short interest in over a year, maybe many years. The data I pulled only went back 1 year, and it's dropped off to crazy low levels. And if you're not familiar, that's not bullish, that's bearish. It's bullish when a stock has very high short interest, because all those shorts, they are forced at some point, they have to cover. Shorts are the only guaranteed buyers in the market. I always say that. Longs, bulls that want to be long, talk the talk, want to say I like this stock, I like that one, I'm planning on buying Facebook. Guess what? You never have to pull the trigger. You don't have to buy it. Something may change your mind. Now, if you're short Facebook, you have to buy Facebook. What I mean by that, you have to buy to cover your position. You're paying interest, you're borrowing those shares from your broker, and at some point you must close that trade out. So you are the only guaranteed buyer in the market if you're short. Now, so what does that mean? High short interest stocks equal short squeezes, and they're beautiful to be in on the long side. Low short interest stocks equal the potential for a sudden downdraft. Why? Because when you have average short interest or normal short interest, what happens is during the corrections, guess what? Yeah, the shorts come in and cover. So as you start to drop, let's say you break this wedge. I know this is a sloppy looking chart, but bear with me. I'll just put some lines up. This yellow trend line, that's the one I'm watching. That's my main trend line. I went over it with the blue one. There was a yellow trend line there. And that gives us this wedge. And as I said, wedges can continue to, expand. This is just a divergence line, not a trend line. That shows you the divergence. Starting to see PPO roll over and RSI roll over. Hopefully they will soon. That will give us confirmation, at least a confirmed negative divergence. Then our sell signal comes on a break of the trend line, and that 174 level, I think that's a very, very, very significant level. We just popped above it on Facebook, but we're not seeing very impulsive buying. And again, because of these divergences, I put good money that breakout fails. Otherwise, if I saw a lot of consolidation here for months, didn't have the divergences, I didn't have overbought readings, I'd love to go long Facebook on a break of 174 and or a back test. But that's not the case because of that. So therefore, again, now back to the point I was making about shorts, being that the shorts have been completely and utterly blown out. You can get the short interest, by the way. Just Google FB short interest, or I like to do QQQ short interest. It'll take you to the NASDAQ's site. So you're getting it straight from the horse's mouth. NASDAQ, where Facebook and a lot of these stocks trade, will report the short interest. Just keep in mind, it's only reported bi-monthly, twice a month, and there's an 11-day lag time before they come out with it. So it's a little dated by the time you get it. So I was going off the most recent, which was March 29th data. Now, coming back to that. So now, let's say we break down. So what happens, where normally if you had a high or even an average short interest, you break down, you start having the shorts come in and cover along the way, and they step in at the support levels. They would be stepping in here at 159 for sure. I would, if I end up shorting Facebook, that would be a natural target. However, depending on what happens in the market, how crazy the excesses get on this rally, how overbought we get, how low short interest gets, how bullish sentiment gets, that might be a decision to hold on and ride out any bounce off 159 and hold out for a backfill of 150. So that's the point I'm trying to make, is that low short interest is often an ingredient for those quick swoons down and in the large and powerful swoons like we had last quarter in the markets, or I should say the fourth quarter last year. Okay, I won't go through them all. We'll stop here, or one or two more. There's Intel, minor uptrend line right there, giving us this wedge right there. Semis, believe me, are very much on my radar for another short entry. I don't care. We've had, what, two, maybe even three trades stopped out on the semis and QQ. No, three on QQQ, I believe, this year. All for small gains, relatively small gains, but trust me, that is certainly one on my list. And so there's your wedge. There's an alternative trend line that's likely to come into play, and there's a potential target down here around 56. But as I said, with the broad markets, we have absolutely nothing even remotely close to a sell signal. So please don't ever confuse a trade setup with a trade. Trade setup is a stock or an ETF that's setting up in a technical pattern that looks to be poised for reversal. Intel, I covered this rising wedge every day for months right there. Setup, setup, setup. I talked about the divergences, but we didn't have a sell signal to this point, and there was your sell signal right there. Boom, breakdown of the wedge. And then you had a similar thing in reverse. This is a setup here. You have a falling wedge pattern. That one broke out, back tested, and then went up. So right now, again, potential setups on all of these, and that's what I'm looking at here, the trend lines on these big components of QQQ. Cisco, oh, look at that, just big divergent high, extremely overdone. Look how overbought the stock is. Such overbought readings usually don't end well. You can, again, if you don't believe me, just go back in time. Look at the RSI. The red line is 70. That's overbought. You get overbought plus with divergence, and that's where you usually get the big corrections in stocks like Cisco. And this one, I have no doubt, will trigger a sell signal here. And I'll say this, it'll be better if Cisco breaks to see some of those other big market leading FAANG stocks follow as well, because if the rest of the market goes up, especially tech and QQQ, what then you'll probably get or could get is a breakdown and then a kickback at higher levels. Sometimes that's what happens when a wedge breaks down, and sometimes you break down and that's it. And the ones that have the very low short interest and extreme technicals are the ones that are most likely to go down and just keep going down and not give you that back test. Okay, if I haven't bored you to tears yet on the broad market, let's change gears and then we'll look at gold. Now, you could also, I'm looking at the US dollar, and I'm really looking at the Euro US dollar Forex pair because that's my preferred trading proxy. And if you're new to the site, I would say the reason is the Euro makes up by far the bulk of the US dollar index. I think it's 59.6, I don't know what it's about 60%. I'd have to revisit the numbers. Then you have the yen at a second largest weighting, but a distant second, and then everything else almost doesn't matter against the dollar. So if you want to know where the dollar's going, you basically just have to figure out where the euro's going, and that will tell you. So I have two trend lines here. I have that yellow trend line and this white trend line here. And the white being the second of the two is what I call the BOD, or benefit of the doubt trend line. That's the one we need to see taken out. We can see some support that the euro had here. It recently broke that support, broke it again. It's trying to get back above there. It would be quite bullish if it did. Why? Because that would be a fake out, a false breakdown. Fewer things in trading or investing are more bullish than a failed breakdown, because what that is, it sucks in shorts. It's a bear trap. Again, if we get up, now we have to get up. So what you're looking for here, or what I'm looking for, is a breakout above this uptrend line. We're getting really close, but we're not there yet. We had one little false start there, one little whipsaw signal that came after the FOMC meeting there. And once we get the breakout and it's confirmed and looks good, I see us coming up here at about that 115.439 level, and then all the way up here at about 118. If that plays out, that would be very bullish for gold. Make no mistake about it. I've done many videos in the past overlaying the charts of gold in the US dollar or the euro US dollar pair, and the correlation is unmistakable. There are temporary disconnects, don't get me wrong, as with any two assets that are correlated, but there is an unmistakable correlation. And it's simple because gold, at least the gold we're trading here in the US, or if you use GLD, the ETF, or GC gold futures, the contracts, they're denominated in US dollars. So if the US dollar drops, and that's what it would do if the euro breaks out against a dollar, this goes up, means the dollar's falling. So when the dollar falls, what does it mean? Well, it takes more dollars to buy 1 ounce of gold, and that's why the price of gold goes up. It's not a magic formula. So when we look at the weekly chart here, gold, let's just go to the weekly, bigger picture. Daily's a little bit noisy right now. This is the bigger picture. We have a very large symmetrical triangle pattern, which I just missed with that line. I'll try it one more time. You can already see the line that's there now. Comes off the bull market highs back in 2011, and here's the trend line off the lows. We recently broke out, and we've been back testing. So my preferred scenario has us coming up here to 130.05, which is a big level. probably get a consolidation, a reaction there, something, and then ultimately a breakout. So this is my longer term scenario in gold. We're just waiting for a buy signal, and as I told you, that buy signal will help to confirm it if we get a buy signal in the US dollar. Gold is a risk off asset, meaning institutions and individuals often flock to gold in times of market turbulence. So I can tell you this right now, although there are disconnects too with that relationship, this would probably coincide with, especially this, coincide with a reversal, a failure in the US stock market, either at or before or just after the coming to test the all-time highs that it's coming up on. Otherwise, if the stock market breaks out and just keeps going up another 10-20%, you're probably not going to see gold rallying with it. You'll probably see gold come back into the triangle, come back down here to support. So this scenario is largely contingent and does align with my outlook for the U.S. markets, that there's minimal upside right now, maybe 2-3% or so. The timing of it's going to be a little harder because right now we're slow grinding up. Maybe we shoot up real quick due to something with earnings next week, or maybe we reverse and have a sharp down day. Remember, earnings season certainly has the potential to cause some volatility in the market. So there's gold. You have my scenarios. I'll do my best to identify the next objective long entry. I don't want to jump the gun because it's been a dead money trade, and you don't get paid. Gold doesn't have dividends, so you're just in gold right now. You're getting grinded around. I made it very clear right after this divergent high here, and even before the divergent high, that it was building, and then the breakdown. But I did make clear that this would be a buy zone between here and here, possibly all the way down to 117.40, but this is my preferred scale-in buy zone. I'm making a mess of the chart now, guys. There we go. Grab this. And so far, we came right about to the midpoint of that zone. But again, I look at this. I can't hone in on an entry point right now. So I'd like to see some evidence that the dollar is broken out, and and some other things, and then maybe we'll re-enter gold as a swing trade and long-term trade. TLT, by the way, on that same scenario I just talked about, with the broad markets, having limited upside before we get a reversal, that would also align with TLT. This is a weekly chart. TLT and gold are the two king of flight to safety assets. That's where money flocks in times of market turbulence. And so again, this scenario would align with a top being very close by in the market, a considerable top. Very good support right here. This was resistance around 122.50. Looks like 122.60 here, but on the daily it's closer to 122.50. So we had a breakout, as I mentioned recently, impulsive breakout. We're coming back in to back test that level. So the bullish scenario for Treasury bonds, which is my preferred scenario, and bearish scenario for the stock market, because that would most likely give us a catalyst for the next leg up in treasuries, would have us coming down, and we're close enough to it now to start scaling in to that 122.50-ish level on TLT for the ride up here to 122.58, or maybe, like I said, maybe a back test of that trend line, that longer term trend line right there. Going down to the daily chart, because somebody asked me about it today. There we are. We're close to that 122.50-ish level. You can see how well defined it was back here. It was support for a long time right here, broke, and then it was resistance all year, 2018 into 2019, with just one little whipsaw signal, and that's fine. If I see dozen reactions on a level and one pop above it that we go right back down, that's fine. You get whipsaw signals once in a while, but there's enough reactions there to validate it. So now, whether or not it holds, I can't make any guarantees of that, but I can tell you that it was solid resistance, which should make it solid support. And so on or about that level, it looks like an objective long entry on Treasury bonds. And again, it will probably, the success or failure of stepping in and buying TLT here will probably largely depend on what the stock market does. If the stock market just blows through the new high or the old highs, keeps going, treasuries will probably keep falling, because people won't want that safety of bonds. It will also imply that the economic growth the outlook is picking back up. A lot of things come into play there. What else can I tell you about it? Oh, let's just give you one potential bearish outlook or scenario for this. You know, I pointed out here we had a divergent high on treasuries. Even before we got it, I told you there was divergence forming. Now we had it. It's confirmed, or was confirmed at that point. And so we had an impulsive move down off that divergent high, and just recently we set up, we consolidated. That is bear flagging type action. Now, if this is going to play out, bear flag patterns don't always play out, but quite often they do, to the measured target, which would be the flag pole, the length of the impulsive move leading down, added to the top of the flag. Now, that flag would only take us really to slightly undercut, and that could be a nice washout move. You know, a lot of eyes are probably looking, you know, to buy TLT at 122.50. And I'll tell you this, there's a reason I haven't added that back as an official trade. We had it as official long before. I have my concerns right now. You know, the market is just, stock market, it's too resilient. So maybe we come back under there and do a little fake out move to get a stop clearing rate on treasuries and then a reversal and back above there. That would be bullish as well, because that would be a failed or a little whipsaw signal there, and probably suck in some shorts on TLT and scare out some longs and maybe set the stage for another thrust up. So I'm watching it, and again, if you're 401k money, that type of stuff, probably not a bad place to have some, just to be diversified, some money into treasury bonds. Okay, we'll wrap the video up with some trade ideas. Like I said, I've just recently did an update on the shippers. I've done plenty of updates on the auto parts. You know, a lot of the longs that we've been looking at are unofficial. They're not related close to the stock market. These two are. I'm going to share two trade ideas I've shared in the trading room recently. First is Netflix. This chart's so busy as hell. I'm sorry about that, guys. I could probably give you a cleaner board, but I don't have it marked up. I probably should have cleaned it. It has the last trade on there. We've had, in 2018, last year, we went 3 for 3. If I recall correctly, we had 3 official short trades on Netflix. I know at least 2 of them were in the same level. On earnings, we had, this was just a beautiful setup to me. We had a short trade right here. We had just broken down this nice clean bearish rising wedge. You can see the divergence just extended, and finally started playing out. And what happened is that big gap, we had a breakdown just before, but I didn't short it. I was watching it, but they were just like where we are today. They were about to report earnings, so I didn't want to add it as an official trade right in front of earnings, because that can go either way. It's a crapshoot. Typically, I won't add official trades, but I'll tell you my thoughts. And I already said in the trading room I've taken a starter, position in Netflix, but I won't add until after earnings. Now, what happened the next day? They gapped way down. They shot. This was a huge candle. I forget what the percentage drop. I can tell you right now, but 13%. But that was too much too fast. I don't chase a 13% down move. Sometimes I'm watching the most beautiful trade setup, long or short, and I might miss the entry because it gaps way above, and it's just not objective to chase. However, we got a gift that day. We bounced right back to this level, this line here, 380, 381. That was resistance. We came up there, and boom, that's where I added the short, and then we covered that one. That was the previous trade, so we covered down here. We nailed it there, covered it for double-digit gain, and then Netflix gods gave us another gift a few months later. At that point, we set up in a bearish rising wedge, and we came right back to that level. We broke down, so boom, I entered there on the breakdown of the wedge, and we hit looks like our third target down here. And at the time I mentioned bullish divergence, everything else. I said going long personally. I didn't add that back as an official trade idea. Kind of wish I had of now, but either way. And again, there was one earlier in the year. So where am I going with this? Anything is possible, but wash, rinse, repeat. There's our last 2 short entries in Netflix, and it just came in reverse, just shy of that 380, 381 level so far again. And then I've been watching this level, and I posted this morning in the trading room right here. This is the level I've been watching, this uptrend line right there. Sorry, I'm using an arrow tool. I meant to use a line tool. And this wedge, so it draws this wedge, and again, like back here, we had negative divergence, and we broke down today pretty impulsively. The reason it's not an official trade, they report next week. Gosh, was it Tuesday? I believe it's next week. So I'm watching it, and we'll see. This sucker is prone to gaps one way or the other. Sometimes they can go against you, sometimes they go for you. You just don't know which way they're going to go. So we'll hold off on watching it, but longer term, I really think Netflix is upside is limited. Yeah, here's a weekly chart of Netflix. There's a major low back in 2012. There's an uptrend line, divergent high. Again, on this is a weekly chart, and we broke down in back test and we rolled over so far on the back test. There's an alternative trend line here that is probably going to come into play. So I think if that one gets taken out, we come all the way back down to at least 200 Netflix. It's 353 right now, so I'm really hoping to get a short on here. And if the broad market can roll over and confirm that, all the better. And that way I maybe can tuck that one away and hold on to it. There's a weekly. I had on a 6-day time period chart. There it is, weekly. So there's the $200 potential longer term target right now with this trend line to watch as well. And then one more. This video is getting long. I'll just give you one more. This one I've been watching forever. Back in late 2016, I posted more of a fundamental post as well as technical about the PBMs, pharmacy benefit managers. There were 3 I posted at the time. One of them since been acquired. I think it was by not Aetna, one of the big insurance companies. So now we have UNH and CVS. And I said on UNH at the time, I'll pull that poster, I'll put it up later. I said we have to break this trend line to get a sell signal on a weekly basis, and we haven't broken it yet. This trend line goes back a long time. So this one hadn't given me a sell signal until now, and it's given me a great sell signal. Wednesday, they dragged out the executives of these some of the big PBMs and the big pharmaceutical companies, big 3 diabetes makers, crying about the the rising cost of insulin. And I'm telling you, I know the fundamental story here. My wife works for one of those big 3 pharmaceutical companies, and what's going on here, it has to do with the rebate pricing and all that, and I don't want to get too much into it in this video, but they're under the radar, they're under the gun right now, and they've been, now it doesn't matter. So that's a fundamental story where I think their profits are going to come under pressure. I could talk on it all day long, but I can tell you in a simple world, fundamentals don't really matter as far as buy and sell signals, because I was making that case back here, but as I said, I didn't have a technical case or reason to short the stock. Now, barring some super crazy virtually impossible stick save into the close, we'll print a solid weekly close. We printed a weekly candlestick close last week below that trend line, and we're almost certainly going to do it again today. So unfortunately, this stock reports next week as well. I've already taken a position in it, but I will probably add this. Just hopefully they don't, hopefully, ideally they kick back and give us a kickback rally, have a positive earnings surprise, but stay above that long-term trend line. I would love to see that. You can see where I think this stock is going. First stop would be about 210, and ultimately, and this would most likely entail a bear market in the U.S. Stock market as well. But ultimately, I can see this one coming back down here at about 128. So a lot of meat on the bone, if I'm correct on this, and about a 42% drop down there, or 45 or so to my final target. All right, long video, but again, a lot of stuff in there, and we'll watch. Just don't fall asleep at the wheel with the broad market. It's going to go up until it stops going up, and it's either going to roll over slowly when it does, or it can do it with a bang. So if it does so with a bang, just have your ducks in a row, and whether you're long and you need to get out of your positions, or you're short and you want to jump in and take advantage of the next downside trading up. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.